This is a 1 minute chart of the silver bullet here, and this is the silver bullet here on a 1 minute chart. Okay, a lot of overlapping in here, and then finally it leaves the range and it creates this fair value gap, and it trades down into it and it runs away. Let's go into this information a little bit more detailed, and also I want to look at all this imbalance here. Okay, why is it going up to here and stopping? Look right here. Here's your order block here. It wouldn't be past that, beyond it. What's occurring in here? What is all that about? This is institutional order flow. You're not going to see it on a volume profile analysis. You're not going to see it on depth of market. You're not going to see it on a ladder. You're not going to see it on level 2 data. All these things that you think makes you institutionally minded, it doesn't. It does not. All that stuff can be spoofed. What I'm going to show you here is how it never surprises me. It never jumps off the chart and says, oh, I got you, ICT. You didn't see that coming, did you? So think about what I'm showing you here. Study this for a second. Pause the video. Okay, really pause the video. Study everything you see here and all this movement down and where these silver bullet entries are occurring and where price reaches up here. It doesn't look obvious here, but when you drop down to a 15-second chart, which I'm about to do now, so if you're not ready and you're still looking at, don't play it, keep it paused. So you never pause the video. You're missing out on an opportunity to learn. But back to that 15-second chart. Here's that sell side imbalance, buy side inefficiency. Okay. All this run down here and then into this low, we create those relative equal lows. We go down below it shallowly. That little shallow run tells me that any retracement higher is just going to be one more drive lower. And what does it do? It runs right back up to some random level, right? No. That fair value gap right there. See that? It's also a mitigation block, which is this down close candle. High, low, lower high. It's a reversal of sorts on my breaker pattern. So typically a breaker would be a high, low, higher high. A mitigation block is the down close candle in between the high and lower high. So it's trading up into that there and in an imbalance there. And then drives harder. So that's taking out the sell stops here. So it engineered it. It went low, low, created retail-minded support. They're going to buy it. It rallies up. They feel rewarded, and then it comes back down. They may or may not have been stopped. It doesn't matter. Now, if they didn't have a stop, they're really going to put a stop loss there, right below those lows, in that low, in that low. And then you see it go wham. Spends time down there trapping traders. Then it rallies. Takes out a short-term high. That's a shift in market structure. Creates a fair value gap on the 1 minute chart, but look closer now. This is a 15-second chart. ICT, come on, bro. Seriously? Like, I'm not looking at 15-second charts. Okay, then this lesson isn't for you. I've already taught you how to trade using the model 2022. You don't need this. You don't need this to make my stuff work. But if you want to be a freak, okay, if you want to be a freak in technical analysis, no, slash that. If you want to be a freak in technical science, because that's what I teach, okay, we do technical science here. It's not contrived, it's not conjecture, it's not guesswork. We have this down to the smallest degree and the highest degree of precision. Look closer. Inside of that shaded area on a 1 minute chart is a fair value gap, but you don't see that as a fair value gap here on a 15-second chart. In my charts, in my monitors, I have one monitor that I use and I dub it as a intraday matrix where I'm toggling through constantly. Just by a couple keystrokes, I'm going through 5 minute, 4 minute, 3 minute, 2 minute, 1 minute, 45 second, 30 second, 15 second, 5 second. I'm looking at charts just like that as I'm looking at key levels. So when we're in this institutional area here where orders would be resting, what kind of orders? Sell side liquidity. Then it rallies up and we have a shift in market structure. Wonderful, because I'm expecting that buy side liquidity, which is outside the scope of this chart here. Remember, it's above. That's where I think it's going to go. I told you that last night. This 1 minute imbalance here that's shaded, it doesn't look like a fair value gap here. But what is overlapping on a 15-second chart that's still useful using what my PD array matrix taught you in the core content on my YouTube channel? 2 down closed candles is a bullish order block. Extend that to the right. We're digging down into that order block there, rallying and coming back down into it again. There's an order block and a fair value gap. That right there, if I didn't buy it on this pass here, I would see that and be going long. And I would buy it again here and adding more to it in pyramid. That's why you see me sometimes entering, and it's like, why is he buying it? Like if I'm going long, for instance, I'll do executions and I'm recording it. I'll go long, buy it, and then a couple seconds later, I'm buying it again. And it's like, what is he doing? It's this. I'm buying it here, I'm buying it again, and I'm adding it here. So it's like 6 contracts long, 4 contracts long, 1 contract. Or I'm sorry, 6 contracts, 3, and then 1. That's my 10 contracts. So it's 6, half of that's 3, and then there's no half of 3 that I can do. It's 1 contract. So that's my standard 10 lot model where I build in. If I think the trade's good, I'll do that. Well, if I don't see the lower time frames doing this, I'm not going to do those real close proximity entries where I'm showing you multiple entries generally in the same area. I'm dialing in with a very small sub 1 minute contract basis. And it looks just like this, but you're not seeing it because you don't have a 15-second chart or less than 1 minute. TradingView offers that. I don't know what program or package you have to get that, but I'm the highest level membership there, so I think it's like $600 a year. But if they do the same thing they did last year on Black Friday, you can get it really cheaper than that. But if you don't want to spend $600 to have this kind of information, or you can't get it somewhere else and you don't want to pay for the data, forget trading. Because if you don't want to invest in the tools to be able to do these types of things to this degree of precision, you're probably not going to do well. Okay, there's no free way in this. Okay, I may be teaching for free, but it's still going to cost you something. It's going to cost you time, which is very expensive. It's going to cost you money in resources and some kind of platform. And if you want to have the degree of precision that I teach and make available to everyone with my teachings and lectures, this is one of those things you're going to have to reach into. You can't just simply look at just a 1 minute chart and think you got everything that I've taught, because I'm below a 1 minute chart on everything I trade, everything. And I'm looking at these types of things here. Same thing here with that silver bullet up here. This range is a 1 minute fair value gap. You can't see a fair value gap in here. You see this down close candle though, don't you? So when it's trading down into that, that's where I'm going long. I'd be buying that order block right there. And then as it was dropping down, if it would have hit that again, that shaded area right on here, on the 15-second chart, I would add to it there. And the market runs up. Look a little bit closer now. Look at its inefficiency. All of this movement down here, there's pockets where there is only 1 candle passing through. We have this small one in here. We have a small one right in here. All of this here, 1 candle pass through, 1 candle pass through here, and right in here. This one here is essentially repriced to right there. And it's rebalanced because it's left it here, here. So this was of no interest to me. This one gets filled in and repriced and balanced because it's back and forth inside of this area here. So now that's balanced. If we rally above that high, then we should have no problem going higher and not ever need to go back below that high. What I just said is huge, because everything over here is telling you the narrative that needs to be displayed in price delivery. Once we have this back and forth movement, that means it's efficiently been balanced. Once it leaves it, that means goes above it right there. It never needs to go back below this high. Does it? Not until it goes above and rebalances into this area here. This range here is this price formation. It reaches up into that, then it pulls back lower. This range in here, it trades up into it here, finds support at it, and then rallies above. It does not need to go back below this high. It's acting as support, rallies up. Again, as I taught last night, if you want to understand what classic support resistance is and what it means for you to look at it in charts, and you don't want to be this in depth, you don't want to be a technical science major, you want to see simple trading, then you look at these inefficiencies around levels you would expect as support resistance. And if you see the things I'm teaching you here, you'll probably be safe in trusting that as a support or resistance. Doesn't mean you're going to be 100% accurate. It just means that if you're trading with support and resistance ideas, if these inefficiencies that are to the left of the chart are balanced, not just repriced to, when they're balanced, that means up and down price delivery, and then it leaves that range. Then it becomes a real balanced price range, and then you can trust that it won't go back through it. It'll act as either support if it's going higher or resistance if it's going lower. You can see that area here. They work this level here back and forth. It's balanced once it leaves it. So then all I need to do is see it trade above it. That high right there gets traded above it, comes down, never sees it again until we get to this area here where this is inefficient and it's been rebalanced. This candle here trades down, then it opens, trades down, up, and leaves. That range is the only exposure for inefficiency because this candle went up, this candle went down, this candle opened, went higher, and then back down. So this range here and higher to that high it's balanced. The inefficiency is this candle right there. So that's why it only went right up to that, to the tick. 2 candles and then plummeted down to new day opening gap low, and then down into, which is a little bit to the left, I'm sorry, to the right of this. It's not in the scope of this fractal being shown, but it's the consequent encroachment of the Tuesday, Wednesday opening range gap. All right, here's a 1-minute chart on the E-mini S&P afternoon session between 2 o'clock and 3. This is your PM session silver bullet. Now here's where we've seen the price rally up and go into our objective. This is the buy-side liquidity pool I told you that it would reach into last night before we got there today. It did so during the 2 o'clock hour. It ran through it and then broke hard lower, leaving this inefficiency right there. The market trades up into it. That would be a short for a silver bullet because we hit our objective. We broke down and we could look for this inefficiency here, and it has a real gap. You see that? This, friends and neighbors, is a real liquidity void. That is a real liquidity void. This is not a liquidity void. This is not a liquidity void. Okay? This is a liquidity void. Where this candle stopped and this candle started, that separation there is no price data being printed at all. No trades existed there. So when it did this inefficiency lower, it's a fair value gap, yes, but it's a SIBI, sell-side imbalance, buy-side inefficiency. That means it's lacking what? Buy-side. That means a candle or candles must go up in price delivery in that range. We see it return back to it here, and this would be a short, expecting it to go back down into this inefficiency and trade to that real liquidity void. It one more time pumps up into here, doesn't even get back up to the first silver bullet fair value gap, breaks again. There's a small little gap in here, and I would counsel you to take a look at this, and you might see this here and think, oh, this is one that would have been potential entry too, but would I enter there? No. Well, you got the benefit of hindsight. You can say that now. Look what it's done. It took sell side out here and then rally back up in. This is too close in proximity, so it could run above here to take out buy side and not get this high. So I would want to go into a lower time frame and look for something a little bit higher than this, or study and see if there's anything more in this area here as another fair value gap that may not be seen or visible in this 1-minute chart. I'll drop down into a lower time frame. We'll go into a 10-second chart and show you what that looks like in a minute. But the market breaks lower and does in fact trade back down into this inefficiency and rebalances price action right at that real liquidity void, trading down into 41.53 3/4. Now the question is, does it offer 10 handles or 10 points in range for potential high probability shorting? Because we've already hit our objective, the buy sell liquidity pool. Remember, that was the target we had last night. I gave you that. It hit that, and it hit it during the PM session, 2 o'clock on a Thursday. Thursdays can generally, not always, generally give you the opposite end of a range. Since we've been bullish all week, chances are we can create the high of the week in Thursday. Doesn't mean it will always. It's just many times it'll give you trades that are very short term and give you this type of movement here. We eventually try to go back up again, but it's enough to be paid on it, right? Silver bullet, 10 handle range. Does it offer that? Well, if we're going short here at this candle's high, 41.69, all it needs to do is book and print 41.69 1/4, and the spread should fill you. Being short, it does more than that with this here. We're going to assume this is not a real trade here. This is just for annotation purposes so that we can do the same thing in your journaling. This is where you would be filled. This is how much heat you would have taken or drawdown. And then the market breaks lower. And as the market trades into the lower end or consequent encroachment of this inefficiency, that would be about right here, the spread would probably be required on this candle here. Notice I'm not drawing it on the lowest candle, which is impractical. I'm showing you where, this is how you want to do your own back testing. Annotate where you would have been filled. Do not try to pick the highest high and the lowest low. That's not going to do anything for you. That's not going to make you a super trader. Okay, it's not going to make you that precise because you see it in your charts annotated that way. Be realistic and practical when you're doing your back testing. Where your orders would have been filled, using the logic and the rules I'm giving you, that's what you annotate. And then that way you can study with realistic expectations how much heat or drawdown that your entries would have incurred. You can see that that's not the actual high. A little bit more heat is given before it drops down. Now, right away, I'm reading your mind. I'm getting an impression now that you're thinking, why wouldn't you expect it to completely go all up here and close that in? Well, what did this run here do? It ran the target that I gave you last night. It ran buy-side liquidity, and it did so energetically. And then we created this gap here. So this is a blow-off type move. It's kind of like capitulation. I'm not suggesting that we've made the high. I'm trading it and showing you with the expectation that we can treat it that way. And this is much like a breakaway gap. This gap should not completely close in. Notice that it came back up later on, but it didn't completely close it in. It left some portion of it open still right there. But we only need 10 handles to see if it's going to offer us opportunity between 2 o'clock and 3 o'clock. The range entry from 41.69 even, which would be this candle's high here. If we were getting short there, 10 handles lower or 10 points lower, which would be 41.59. 41.59 is down here. We haven't even taken out that low to get 41.59 yet, and we're aiming for this. So yes, it would be a high probability trade. So 41.69 to 41.59, there's 10 handles. You can book 5, take a partial at 10, and see if you can get down into this closure of this inefficiency. But I would aim just for that real liquidity void. I wouldn't aim for the low. Even though it did offer it, I would be closing right there as it got into that. So I'd be out there, or best case scenario, that one. And I would miss any further down movement here. And then I would be not engaging at all in any of this. Everything I just showed you, now we're looking at on a 10-second chart. So here's that inefficiency. You can see it's one single candle here. And then your fill would be there. That was where you'd be filled. And this is the heat you took on it, or how much it would be losing against the open position short. You have an up close candle here. This is a bearish order block. The market trades lower. See this inefficiency? That did not exist on a 1-minute chart. This is the 1-minute fair value gap. After it took off below this low here, went down, and then ripped higher back up into the order block. And look at the inefficiency here. See that? Went into it, touched the order block, traded sideways a little bit, broke down back into the high of the fair value gap, and then repriced lower. Then we started respecting that 1-minute fair value gap here, and then we left it. Breakaway gap. Moves lower, digs into that real liquidity void, which was about halfway of that pink area. If you looked at all these levels here, and I showed you this chart like this, it'd be like, man, what is going on here? What is all this stuff on the chart? It's insight that I see without having it on my chart. I have these levels annotated. And as I'm watching price, I'm constantly referring to, okay, the 4160.75 level is the high of the Wednesday, Thursday opening range gap. So as we're trading down, I'm expecting, okay, I want to see how it trades there. It hits it, comes back up, fills in a little fair value gap. That's normal. Strong break lower. Okay, as it's breaking strong, I'm looking at this ghost image of the previous opening range gap. I want to see, does it dig into that? Yes, it does. And also, it digs into the new day opening gap. So all these levels, I'm watching. I want to see it go a little bit more. I want to see a little bit more. Every time it reaches into one of these levels or another PD array that I may have interest in, I'm anticipating some measure of retracement. And if there's an inefficiency just formed, I'm expecting it to reach back up into that like it's doing here, here, and then digging down deeper. And this is where I would have had my exit as it traded into that real liquidity void, or that separation in between the two candles, which is right there. So all this congestion in here, that's being shown on a 10-second chart all through here. But this level of detail, you can't glean that from a simple 1-minute chart. You don't need this to be profitable. You don't need this to find silver bullet trades that work. But I will find trades that won't exist in a 1-minute chart by using sub 1 minute. I mean something less than 1 minute. And I'm comfortable with that. You may not be comfortable. Just because I can do it, just because I like it, just because I've been doing it, does not mean that I'm twisting your arm saying that you have to do it too. All these things work. You don't even need to be trading with intraday charts. You could be trading with a daily chart. You don't need to do intraday. I teach intraday because it gives me a lot of examples and a lot of opportunity to present things that would take a long time to manifest on higher time frame daily and weekly charts. So, and because it fits my personality, I'm comfortable with making high frequency decisions. And high frequency trading is done on these sub 1 minute candlesticks. They're using these types of inefficiencies and points of reference for their algorithm. They're only shorting when the market goes up. They're only going long when the market goes down. And they're reading inside of all this. Remember, just because it's doing all these fair value gaps here doesn't mean anything. Just because it went up to this order block here doesn't mean anything apart from the fact that we went into that buy side liquidity, which is the level I said we would run into, which we did here at 2 o'clock up here. Once it did that, and then it broke aggressively right there, I want to see does it get back below that high, which is this blue line. It does. It breaks down below it, overshoots this inefficiency, even on a 10-second chart, and digs down into the volume imbalance right there. There's no bodies overlapping. It's just a wick. Boom, it hits that. Then it runs one more time back up into the 1 minute fair value gap, which is here. Boom, boom, 3 times. This is the 3 guys pattern. Very classic pattern. Then breaks lower. Inefficiency. I like that one. That could be a short. I would be adding to that. My stop would be above here. But what happens if you would have got stopped out ICT? Then I would have waited for something like this to occur later over here. Once it broke down and created another fair value gap, I would be short in there and adding it just the way I've just explained it here. So here's what I've just taught you tonight. Obviously, I taught you a greater degree of precision and why I do my entries where you see me entering them on a 1 minute chart or a 5 minute chart. It may not seem logical to you, but I'm looking at these lower 1 minute and less charts. And I'm looking at all the inefficiencies, the order blocks, the point of reference that I'm showing you here. There's just an introduction to it. Every PD array that I've taught, plus the ones that I will never teach you, I'm looking for them. You don't need all that stuff. But I can teach you how to do this, but you have to be willing to listen. You have to go into the